Okay, gang, hello and welcome to Module 4. I'm going to lecture for about an hour, maybe a little bit more, on credit risk analysis and interpretation. Last week we talked a little bit about the balance sheet and specifically equities, shareholders' equity, and tonight we're going to talk about credit, the supply for credit, some of the ratios that we use to analyze the health of a balance sheet as it applies to credit. You'll see the world of credit analysis through the lens of somebody who works from S&P, Fitch, Moody's, one of the major credit rating agencies. And so let's get to it. First is supply and demand. When you think of supply and demand, it's just like the supply and demand for anything else. You have borrowers and lenders coming together to create a demand for financing public institutions. Demand for credit is mostly businesses, consumers, mortgages, credit cards, and you'll see as we move through the lecture a little bit, there's a market for all of these different types of credit that can be bundled and repackaged and almost customized to meet any risk return criteria that an investor would want for their personal portfolio. And then the investors become major insurance companies, banks, pension plans, hedge funds, so on and so forth. And they facilitate a huge market for government credit, corporate credit, personal credit lines. It dwarfs the equity market by a significant manner. Okay, credit demand for operating activities. There's three different types of credit that basically follow the cash flow statement. So investing, operating, financing. Anytime that we have business interests in one of those three different fields, there's typically a credit line to match that. So with regard to operating activities, I want you to think of like accounts receivable, accounts payable, general working capital. These are routine, low risk in nature. Our authors note here that they're typically cyclical. They can be seasonal in nature. They can also be high risk when used to cover operating losses. So what we like to see is a steady history of demand. For example, if you're working with a seasonal company, say it's a retail company, when we know 80% of all retail sales are not quite hit in the fourth quarter. So a company might need to finance its inventory in advance of that, and then sales come in the fourth quarter and cash receipts come in the fourth quarter through January and February, and then all those cash receipts are used to pay off the debt that they accrued to finance the inventory. Pretty typical operating nature of things for a retail business. Wouldn't necessarily give us any concern. If it were the other way around, though, and we saw a business that had taken out money and then failed to finance the inventory to pay off those debts, and were rolling that over in a manner that might cause concern, that can become high risk. So it's just important to recognize that. Credit demand for investing activity is pretty self-explanatory here. If we need to borrow money to finance a big manufacturing facility or a warehouse or a big piece of capital equipment, there are markets from that. Typically we would take out a loan for a bank using that piece of property, plant, and equipment as collateral, or if it's a major expansion, we might go to Wall Street and finance that with the bond market. The credit demand from financing activities is a little bit less frequently, but you might see that in the form of loans or bonds that are coming due if we don't have the capital on hand to repay those with funds from operations. You might see a company refinance those periodically. That can result in something that we call evergreen debt, and if this is the case on the company that you've chosen for your semester research project, just beware. Ask your management teams what their plan is to pay that back, because if they don't have a plan, if they're relying on evergreen debt, that can be a huge red flag take a market like 2007, 2008, the credit markets all of a sudden seize up, there may be no opportunity to refinance that, and that can push a company into bankruptcy. The other financing activities that we're seeing a lot are to borrow money to either pay dividends or buy back shares. Share rebuybacks by some accounts have been responsible for 50% or more of the market increases over the last 3 years. The S&P 500's up over 300%. A lot of that's on account of low interest rates. When interest rates get so cheap, it makes a lot of sense for companies to borrow cheap money and then put that money to work buying their own shares back in the market. You reduce your share count, that makes your price to earnings multiple decline, just as a nature of the ratio. And as your PE multiple declines, that creates interest in the stock. It creates demand for the stock because all of a sudden it looks cheaper to investors. So that's also a trick that management teams can use to push up their earnings per share, and if their earnings per share is also linked to their total comp package, they're going to make more money. And that's a financial transaction that's a pretty simple one to pull off, so be on the lookout for that. If your management team is lining their own pockets with share repurchases, I want to know about it. Point that out in your report. On slide 7 here, the authors give us some examples of different sources of credit. Non-bank financing, you might think of non-bank financing as a private equity shop or preferred financing of some sort. Bank loans, pretty self-explanatory. Trade credit usually comes from one of the vendors that we're doing business with. Publicly traded debt or bonds financed in the open market, usually by a large brokerage house, and we're going to take a look at those here in a minute. Lease financing, you might see this in the aircraft industry or auto industry. There's some big firms like GE that make business in financing aircraft. Skipping to slide 9, let's break down bank loans a little bit because there's several different variety of these that you might see in your 10K filing. And they can be structured in several different ways to meet specific needs and to work around different regulatory environments and to meet different rules. But a revolving line of credit is going to be something that looks like and functions a lot like a home equity line of credit. If any of you own a home, you might have a home equity line of credit outstanding. Doesn't necessarily mean that you've borrowed the money, but it means that you've contracted with a banking institution to reserve that credit for future draw. So they've guaranteed that you have X amount to borrow from the bank, but as long as you haven't borrowed it yet, you're not paying interest on that line of credit. It just gives you guaranteed future borrowing capacity. You might think of that as your rainy day fund, or you might engage in a transaction like that in advance of an expansion that you know you're going to be embarking on. Usually carries with it a floating interest rate. A line of credit is another very common financing vehicle, very similar to a revolving line of credit, only it typically has an expiration period associated with it, whereas a revolving line will automatically roll over from one year to the next. Letter of credit, slightly different. Those are going to meet a very distinct financing need. Before you go purchase anything major, maybe a new business, maybe this is M&A activity, the buyer might want to see some proof that you actually have the money, in which case a bank could write you a letter of credit that says, yes, we have indeed agreed to finance this transaction, and you can take confidence that the money is going to go through because here's a letter of credit. Two more types, term loans and mortgages, both pretty simple. You're familiar with the way mortgages work. Term loans are similar to mortgages. They can have a fixed rate or a floating rate, and they'll similarly have a discrete term associated with them. I'm going to briefly zip through the three other kinds of lending that the authors laid out in that first slide. Non-bank private financing, I mentioned that this might come from a private equity firm or something similar. These are private sources, results from private lenders, and the terms on any agreement are going to be structured independently. So you're really going to have to dig into the fine print to understand what the interest rate is, how that has been structured on a periodic term, what collateral might have been pledged, and any covenants associated with that loan. And that's going to be a common theme among bond financing and even some structured leases, like we see here in this lease financing slide. The fine print is going to dictate the terms that the lender has set out for the lendee, and the lender can define those terms any way they want to, as long as the lendee agrees to it. That money comes with strings, and as an analyst, when you're taking a look at your research project company, you need to be aware of what those strings are. So dig into the 10-K filing a little bit, and if one of your companies has a big bond that's coming due in the next couple of years, find out what the covenants are associated with that, because oftentimes they'll be tied to specific financial ratios, say a fixed charge coverage ratio, or last week I think we talked about just an interest coverage ratio. And we need to monitor those over time. If they get close to those covenant thresholds, that can be a really big deal and can raise all sorts of red flags, because lenders give themselves a lot of flexibility in terms of what they can legally do if those covenants are breached, up to and including pushing a company into bankruptcy status so that they can foreclose on assets and get themselves repaid. So that can be a huge deal for your company. You need to be aware of just what exactly they've agreed to. Publicly traded debt, some general parameters around that, raised through public markets, several different types. Commercial paper is generally short-term in nature. Bonds, sometimes you'll hear those referred to as debentures, are public borrowings regulated by the SEC, and then the principal is going to be paid back using fixed terms. Usually these are going to be semi-annual or annual interest payments. Semi-annual is the most common, and we'll look at how those are priced here in a minute. Okay, moving into learning objective number 2, explain the credit risk analysis process. Let's take a look at that. What the bank cares about when they're looking at this debt is the lendee's ability to pay the debt back, and with interest, obviously, and then the size of that debt as it compares to some of the other obligations that they might have on their balance sheet. So they're weighing these two things as they look at the creditworthiness of the borrower. So credit analysis breaks down like this. We get 4 steps, and really this is very similar to equity analysis. And we're spending 12 weeks, really 15, talking about 15 discrete modules that clearly define and track and study the equity analysis process. And that takes us through the income statement, balance sheet, statement of cash flows. We make adjustments as necessary, monitor the competitive environment, do a SWOT and Porter's 5 forces, and assimilate all this data into an analysis that helps us put a valuation on the company. Well, the formula for credit analysis is very, very similar. We're going to do all of that, and then really we're going to stop a couple of lines up on the income statement, where the equity analyst is concerned with returns to shareholders. We're primarily concerned with returns or earnings before interest. And that line is going to determine how comfortable we ultimately are as a lender to the company in question. So steps 1 through 4, assess the nature and purpose of the loan, assess the macroeconomic environment of the industry conditions, perform a financial analysis, and then finally perform prospective analysis, or what we think is likely to happen in the future based on everything that we know that we've been able to gather about a company. Okay, step 1 here. What are the funds rather going to be used for? And we talked about cyclical cash flow needs a moment ago. If we're financing inventory for a retail business, that's going to be pretty easy to get our minds around based on the last 5 to 10 years worth of sales. Are we funding a temporary or ongoing operating loss? That's going to be a little bit more high risk. Major capital expenditures or acquisitions. If a company has a history of deploying capital periodically throughout the the last 5 or 10 years, then that might be something that we can predict with a degree of certainty. Acquisitions, a little less so, although there certainly are management teams that have proven track records in that regard. Others are going to require a little bit more work on our end to make sure that we're comfortable actually lending the money. And then lastly, reconfigure the capital structure. There's a lot of different purposes that we can put money to work. As we assess that macroeconomic environment, which was step 2, I compared this to the equity analysts using Porter's 5 forces and SWOT analysis. Similarly, we want to analyze the industry competition, the buying power, the supplier power, so on and so forth. Threat of substitution, threat of new entrants, those are all part of kind of that 5 forces framework. Step number 3, analyze the financial ratios. I mentioned interest coverage ratios, fixed charge ratios. We're really going to look up and down the income statement and balance sheet and analyze everything that we would as an equity analyst. Again, to understand the strength of the business as a whole, and that's going to help us assess the company's general ability to pay us back. Profitability analysis. Last week we talked about net operating profit margin and net operating asset turnover, so both of those components are coming in here. Again, in Module 4. In Module 3, we also did a DuPont analysis, so all of those techniques and ratio analyses will apply for credit as well. And then lastly, we're going to perform a prospective analysis, and we'll get much deeper into this in Module, I think it's Module 11, where we create pro formas for our target companies and forecast those into the future. So everything that we've learned this semester on the business and the operating environment and the macroeconomic forecasting and the company's own internal growth forecasts, we're going to take all that and determine what we think is the most likely future course for this business. And then based on those numbers, as a credit analyst, we can develop some level of certainty around, again, the likelihood of getting repaid. And then with all that information, we're going to calculate something that we call the loss given default. Because normally we'll take on some collateral. So if you think of a home mortgage, for example, most home mortgages are set up that you have an 80% LTV or 80% loan to value. So if a home is worth $100,000, the bank is generally willing to loan $80,000 towards the purchase. And in that transaction, the general calculus is that if something goes back and the borrower is not willing to pay back the loan, the bank can foreclose on the house, and the house would still have a $100,000 value, in which case they could sell it and get repaid on the loan. So that loss given default is a very important component of any credit analysis. And as you can imagine, the higher that loss given default number is, the riskier the loan. And the riskier the loan, the higher the interest rate that's going to be associated with that loan. Maximum loss potential, the major determinants of that are credit limit, collateral, repayment terms, and covenants. I already mentioned covenants, but similarly, collateral, credit limit, repayment terms, those will all vary with every little nuance that we've looked at through the first 20 slides of this lecture. Whether you're borrowing from a bank or a private equity company or the public bond markets, those can all be structured in different ways, which means different payoff terms, different interest rates, different credit limits, different collateral, and then finally the most opaque or confusing of the 4 can be the covenants, because those can quite literally take on any shape or form that the lending institution wants them to. Most of the time you're going to see fixed charge ratio or an interest coverage ratio set at a certain threshold, and the company promises that they won't breach that threshold. Or maybe you'll see a covenant against mergers and acquisitions, or a covenant against issuing new dividends. Those are all very common associated with that. So be on the lookout for those types of situations. A couple other things that a credit analyst is going to look at. the maximum amount of I guess call it a term or of money that can be loaned at any point in time. If you have $1 million line of credit outstanding and you're already at 800,000 and you're trying to tap that for another 1,000 or two, that might start to raise little pink flags to the bank, because they set those limits, and they're typically very firm with those based on the amount of risk that they're willing to take on. And every time you hit that line, they get a little closer to their maximum risk, and you're going to get a call. You're going to get a call from your bankers. They're going to want to know how it's going. What's your plan to pay this back? Tell me about your business. And that's that's a common job for students out of UMKC that are interested in banking as junior trade credit analysts. So you might just be mindful of that. Okay, I suspect this next slide on collateral is pretty self-explanatory, so I'm going to skip through that one. And repayment terms, most of this lecture should be review, but there are some terms like covenants in here that I want to make sure that I stop on, and I talked a little bit about those. But a couple other types that our authors mention would be the covenant that require the borrower to take certain actions, such as submitting financial statements. That's very common. Or potentially restrict mergers, like I mentioned, or to maintain specific financial ratios or minimum equity or something like that. Okay, moving on to learning objective number 3, compute and interpret credit risk measures. Let's look at a couple here. Net operating profit after tax, we talked about this last week. The formula is still the same. We're going to take operating income less tax expense, and then we're going to add back the tax shield associated with interest and other items that are not a part of our operations, and multiply those times the statutory tax rate. And in this example, we're looking at Home Depot. We have a notepad of 7.4, I think that's probably billion. Profitability related to credit risk. Repayment of debt is more likely when profit is higher. This, I give a gold star to our authors here, and recognizing all the while that it's got to be extremely challenging to write a textbook, and when it's your job to come up with 1,000 pages, you end up with little nuggets of wisdom like repayment of debt more likely when profit is higher. And I say that in jest, but that one should be pretty self-explanatory to everybody tuning in on this video. Let's see here. I want to move on to something else slightly more technical. Coverage analysis. The coverage analysis generally refers to how much money are we making over and above what we owe to the bank to service the debt and pay our interest. And you can calculate it either way. These are cash flow ratios. And there's 4 primary types: times interest earned, EBITDA coverage ratio, cash from operations to total debt, and free operating cash flow to total debt. We're going to take a brief look at each one, and I want to make sure that all of you have the opportunity to look at these 4 ratios both across peer groups and across time. Those are the 2 most common techniques that we're going to be using to track ratios in this class. So as you look at your company's financials, go back over time and see how these ratios have trended. Are the trends getting better? Are the trends getting worse? What's driving those trends? These will allow you to glean some real insights into how your company's being managed. Same way for peer groups. Take a look at these ratios and compare them to your peer groups and see if your company's in a better operating position, worse operating position. Evaluate their competitive place in the industry using these ratios. Okay, first up is the coverage analysis, and we'll start with a times interest earned ratio. We're going to calculate that by taking earnings before tax and interest expense divided by interest expense. So how many times do we generate the amount of interest that we owe the bank on a periodic basis? Higher is better here. If I'm the bank and on a quarterly basis you owe me $1 million worth of interest, then on a quarterly basis you're generating earnings before tax of $10 million. I feel pretty good about that. And if the earnings have a measure of consistency associated with them, then that's a good looking number. A couple of points that our authors make here. This reflects the operating income available to pay interest. And then the second point on this slide says assumes only interest must be paid because the principal balance will be refinanced. Now, when you make that assumption, we're flashing back to the second slide or third slide early in the lecture where we referred to something called evergreen debt. If you're assuming that the principal balance will be refinanced, then you've just identified this as evergreen debt. And I told you to be on the lookout for that because it's high risk. Evergreen debt might not be able to be refinanced if you have any sort of banking crisis, or if you're in danger of breaching a covenant, or who the heck knows. There's 100,000 different reasons why you might not be able to refinance your debt when you need to refinance your debt, and then all of a sudden you're in a real jam. So I like to use times interest earned ratio here with some of the other ratios that we'll use to analyze a company's creditworthiness in whole, one of which is EBITDA coverage. So we have earnings before tax, earnings before interest, tax, depreciation, and amortization divided by interest expense. This is a little bit more of a, I'll say liberal ratio because we're adding back a couple of non-cash items, which are depreciation and amortization. Now, depreciation is a future expense, or at least should be, because it represents the future purchase of an asset that's depreciating that we're going to need to replace to stay in business. So if this is an automobile, for example, or an airplane, for example, and we're Southwest or Hertz rental car, we have to replace those periodically, so depreciation is a real expense. It just happens to be non-cash in any given period, so we can add it back. And that's a different way of looking at a company's financial position that also is insightful. Here on slide 35, our authors give us an example of that time series analysis that I will be looking for from all of you. You take these two ratios and you can look at the trend over the last few years. You can see that Home Depot's EBITDA coverage has been, maybe slightly declining from 14 to 15 to 16, but generally around 14. Same way with times interest earned. We'll call that generally around 12. So we have a solid trend there. Next ratio, cash from operations to total debt. So this is a measure of a company's ability to generate cash to cover the total debt. Pretty simple calculation: cash from operations divided by short-term debt plus long-term debt. Higher this ratio is, the more comfortable we're going to be as the banker or the lender with a company's health. And then let's see, number 4 here, free operating cash to total debt. We're going to take cash from operations. We're going to subtract CapEx, because that's a real expense, divide by short-term and long-term debt. Again, higher better, gives us a perspective on a company's operating position. And on the next page here, you can see a trend analysis of those two ratios, operating cash flow to debt and free cash flow to debt, generally trending in the wrong direction for Home Depot. Management might argue that they never needed to be that high in the first place, and there might be some truth to that. But from the lender's standpoint, these loans were definitely looking a little bit healthier 3 years ago than they are in 2016. So there's a conversation to be had in that regard. Moving on to liquidity and solvency measures, two other categories of ratios that we're concerned with as a credit analyst, as an equity analyst as well. We'll want to do time series and peer group analyses for both of these, but generally speaking, we need to be able to differentiate liquidity from solvency. Liquidity is going to refer to how much we have, how much is expected, and how much can be raised on short notice, whereas solvency refers to the ability to meet those obligations. Many companies have been forced into bankruptcy for insolvency when they had maybe more than enough assets on their books to pay those loans. They just weren't necessarily liquid at the time. First ratio, current ratio. It's fairly simple, current assets over current liabilities. Current assets includes things like cash, accounts receivable, inventory. Current liabilities are generally those monies owed to vendors in this is called working capital. Quick ratio is a variant of the current ratio, only we're going to take, basically we're taking current assets here less inventory. So cash plus marketable securities plus accounts receivable. You see that these are all a little bit more liquid. Theoretically, we should be able to turn these into cash quicker than we can inventory. For some businesses, their inventory cycle can be quarters, if not years. Think of a construction business, for example, building a major power plant or road or infrastructure project. It might be years before you can monetize some of that inventory. So we can back that out, and this gives us a better measure for how many assets that a company might have on hand to meet those current liabilities. And if a company should ever find themselves in a situation where they can't meet those current liabilities, well, now you're looking at what can be some pretty dire consequences, up to and including bankruptcy. So take a look at what the current ratio is, quick ratio is for your target companies over time, relative to peer group, and look at it for, you might be interested in knowing what that ratio is for the company that you're currently employed by. If it's less than 1, you might have some real concerns about the likelihood you're going to get a paycheck in the mail next pay period. So that this is not only relevant to credit analysts, this is relevant to employees and every stakeholder inside of that company. So we need to know how to calculate these. Okay, I'm going to skip over this next slide, which is the trend series analysis again, and move into solvency ratios. And here with solvency ratios, we're primarily concerned with liabilities to equity in various forms. And we're looking at the total claims paying ability of an institution, and liabilities to equity ratio, pretty simple, just like it sounds. Total liabilities in the numerator, stockholders' equity in the denominator. And then total debt to equity is a different variant of that, where we're going to subtract out the current liabilities primarily and look at just total debt divided by stockholders' equity. You can see here a nice graphic that the authors give us on slide 44, shows the various liability to equity ratios on average for different industries. And you can see some of these industries are just more capital intensive, and capital intensive industries generally have higher debts associated with them, generally financed with more debt, and there's nothing wrong with that. You just need to make sure that the cash flow is there to service that debt over time. Liabilities to equity ratio, a couple of points on that level of solvency there. Talks about how reliant a company is on creditor financing. We need to be able to distinguish between current and long-term debts inside of there. The current debts are the ones that can really sneak up on us. If you're not paying attention to the current portion of that, well, that's what that's where the defaults begin to happen, and that's what can push you into bankruptcy. Okay, let's jump to learning objective number 4. Explain credit ratings and describe the credit rating process. So before I get into this, everything that we've just used in this lecture so far, the macroeconomic analysis and the financial ratios and so on and so forth, these are the same factors that analysts that work for Moody's and Fitch and S&P are going to use to assign a credit rating to every company that has publicly traded debt. So if the company that you're working on this semester has any publicly traded debt outstanding, you need to find out what the credit rating is. And generally they kind of align with a general school grade type rating system, and I'll show you some more about that. But based on the strength of the credit, that rating agency is going to give it a score. And that score is going to determine things like interest rate and access to future credit. And it's something that CFOs across the country watch very, very closely, because as their credit rate goes, so does their interest rate and interest expense, and then subsequently their bonus opportunity. Okay, let's see. I think I hit most of these points on slide 49. These are the opinions of the credit rating agency. They capture the ability to meet claims. Credit analysts, they use everything that we just went over so far in this lecture. Here's the general framework. So after a credit analyst goes through the same process we just went through, and really the same process we'll be using all semester, they're going to assign a rating that breaks down like this. For Standard & Poor's, you have AAA, AA, those two define a category called high credit quality. Then you have single A and triple B for medium credit. And anything below triple B is what they call non-investment grade or speculative grade credit. Used to be called junk, but they now call it non-investment grade. Same way for Moody's, you have different and various credit ratings here. And as you would expect, as the rating falls, the interest rate that a company will have to pay on that debt generally increases. And as it moves from investment grade to non-investment grade, that interest rate can spike significantly. Okay, and I'll show you here. In this chart, we're looking at the cost of debt. So here we have the 10-year Treasury was at 5% in year 2000, and it has trended generally downward to about, well, in 2016 it was at about 2.5, and I think today it's under 2. The AAA bond is always yields a little bit more than the risk-free rate, which that's the 10-year. And then the BAA bond is always going to yield just a little bit more than the AAA bond in every environment. And you can see a significant spike here when we hit the credit crisis. It didn't affect the AAA bonds so much because the market generally had faith in their claims paying ability, but everybody else saw their interest rates spike, which if you're the CFO and you're thinking like a CFO, then you pay attention to your credit rating because you know something like this could happen. And if that's also the point in time that corresponds to you needing to refinance some of that evergreen debt, you could be in big trouble. This next slide is a nice histogram of credit ratings that are put out by Standard & Poor's. This was for, let's see, year 2016, and you can see the distribution of credit ratings by quality, I guess. So triple B right here, this would be the line between investment grade and non-investment grade. And you can see a big drop off in the number of institutions that hold those ratings, because CFOs know that as soon as their debt is downgraded from investment grade to non-investment grade, there's a whole bunch of bond funds out there that can no longer hold it. That creates forced selling pressure. And when the demand for debt goes down, you have interest rates typically spiking, and that non-investment grade debt is going to require a yield that's just a little bit higher. So that's where that drop-off comes from. How credit ratings are determined, I've kind of touched on this a couple of times. It's an exhaustive process. It's the same exhaustive process that we're going through all semester, and I think you'll find all of this germane to how they're determined. This is an interesting table on slide 46 here. You can see the typical ratios associated with different credit ratings. So now on this graph, you might use this graph if your company had a BAA credit rating agency, a BAA credit rating, and you were worried about falling to a B single A. You might take a look at some of these ratios and see, well, okay, EBITDA to average assets, 8.7. And you just kind of look across the categories here, and if your business is looking a lot more like it has ratios that are in alignment with B single A, that might raise a red flag about the likelihood of a future downgrade. So it just gives you some benchmarks or kind of a frame of reference when trying to quantify the likelihood of an upgrade or a downgrade. In 2006, we created something of a rating agencies for the rating agencies, which is a system to identify rating agencies that are, well, it says right here, they're considered nationally recognized statistical rating organizations because they have such an outsized influence on the bond markets, and this was put into I guess, stark contrast in the wake of 2007, 2008. You want to make sure that these industries are properly positioned and they don't have any conflicts of interest and they're incentivized in the right manner, because when things get a little bit out of whack, you can run into trouble. So the SEC has designated 10 of nearly 100 agencies as nationally recognized statistical agencies, and certainly S&P, Moody's, Fitch would be 3 of those. Okay, learning objective number 5, apply bankruptcy prediction models to evaluate bankruptcy risk. The first and foremost of those are something called the Altman Z-score. Professor Altman, I forget where he taught, but he did some work that showed the predictive capability of the model here that's shared on slide number 59. Your challenge is to know how to use this model. It will be part of your homework. Know how to use this model and be able to apply it to your company. So the Z-score is broken down like this. We're going to use a factor of 1.2 times the ratio of working capital to total assets. Plus, we're going to use a factor of 1.4 times retained earnings to total assets. So you can tell by these multipliers the relative weight or the relative strength that each of these metrics has in its predictive quality or its predictive power in determining the likelihood of a company's future bankruptcy. And in conjunction, they've been shown to be particularly powerful or particularly effective. Now here's how you determine the score. A Z-score of greater than 3 shows that the company is healthy and there's a low bankruptcy risk. If it's between 1.8 and 3, you have kind of a gray area. And then finally, if it's I guess less than 1.8, the company's in financial distress. So find out what the Z-score is for your company, and let me know if we got any that are in distress. I'd like to hear about that. Here's how you apply it. You take that formula and you plug in all of those ratios, multiply it times the weight down here at the bottom of the page, Exhibit 4.1. You add up all those scores, and the total of those scores is your Z-score. And if it's greater than 3, you don't have anything to worry about. That's a little bit of an exaggeration, but that's generally considered to be healthy. Prediction errors: you think it's going bankrupt and it's not, or you don't think it's going bankrupt and it is. These are type 1, 2 errors that are very common to these types of testing techniques, and just refresh your memory with regard to what a type 1 and what a type 2 error is. Okay, moving on into the appendix. I'll cover these 2 slides very briefly. These talks about the major credit rating agencies again, and it's just a nice little graphic talking about how we lay out the analysis process here. Yeah, so not much really there in the appendix. That is Module 4 on credit analysis. Let me know if you have any questions. I am here as always. Email, text, phone call, and I will see you next week.